It's a technical correction. This is an opportunity, whether it's a day or a week away, to be increasing exposure to these areas where we know that earnings are continuing to go up.
There's clearly some sign that speculative activity increased, particularly for retail investors in Korea, and especially moving into some leveraged ETFs. So I think what we're seeing is an unwind of some of that accumulation amplified by the leverage that I just mentioned. Then after the shakeout in the market, we think it will regain its footing and go to higher highs.
And when we look at this sort of investment into a major technology kind of change, usually it's 7-8 years. We still feel we're in the early innings of this.
Some of our guests weighing in as the tech rout extends in Asia, with Korea leading losses as chip makers tumble on fears of overheating in the AI trade. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. The Kospi's 8% plunge triggering a trading halt as the market opened. Bets on a Fed rate hike after a strong U.S. jobs report also weighing on investor sentiment. Oil prices jumping as Israel strikes targets in Iran following a barrage of missiles from the Islamic Republic. That's despite President Trump urging Benjamin Netanyahu not to retaliate. We'll get insights on the tech sell-off and the resumption of Middle East hostilities with Barings Global Head of Public Assets, Martin Horne, who says investors should position for a structurally higher inflation backdrop. Plus, India's central bank and government firing a policy bazooka to support the rupee, dusting off a taper tantrum era playbook to spur foreign inflows. Nomura's chief economist for India, Sonal Varma, will be joining us to discuss whether the RBI is making the right call by passing interest rates to defend the currency. Our top story today, the tech-led sell-off across the region on the back of strong U.S. job numbers as the prospect of higher U.S. rates introduces macro risk to the AI narrative. Let's bring in Bloomberg Markets reporter Anthony Stevens. And Anthony, what's going on with this AI trade across the region, particularly in Korea and Taiwan? I can't say I'm surprised by the sell-off we're seeing today.
Yeah, look, I think your guess, and I mean, I guess from your question, you allude to the fact that, it's a risk management exercise, right? People got too long, too fast, and despite the fundamentals more or less being solid, you're getting a lot of that positioning unwind. And why that is happening is because of a rotation driven from the US rate expectation. So as rates look like they're going higher, you have a rotation away from the more speculative corners of the market to the more value-driven corners of the market. And that's pretty traditional when rates are higher. The markets kind of rotate and look higher. Now in Asia, we are much less exposed to those kind of cyclical sectors aside from technology. And you're seeing that in Korea and Taiwan. What is interesting, though, is policymakers coming to the rescue very early on in Korea. You had the head of the country himself saying that the Korean market is still undervalued. You had SK, Hynix, and NVIDIA come out and have a collaboration around new gen chips. So there's a lot of moving parts today as people try to understand where the fundamental flow is. From a positioning perspective, the flows are very negatively skewed. You do have all these leverage ETFs to unwind. Taiwanese retail is also very long. Similarly, Hong Kong investors got very long this leveraged ETF on Hynix and Samsung. So you have a lot of these complicated kind of overextension on flows that need to unwind before we see a proper kind of settling down in markets.
And of course, we're seeing the dollar strengthening further. There are concerns in the FX space. Asian currencies getting smacked pretty much across the region. What are policymakers doing about steep falls in the currency? Can they actually defend the currency?
Yeah, on FX, it's a much more one-way trade, right? The dollar has been rampaging against proper EMFX for a while. Why I say proper is that EMFX losses have been kind of constrained by how strong the yuan has been. Outside that, currencies have been weak. Actually, the Korean won has been leading the weakness in Asia. So now the policymakers are trying to get ahead of it. So the Korean regulator has been calling up banks, trying to understand how FX trading is going, probably looking to chill some of the betting against the currency. This follows very similar action from India, and before that the rupee. So you're seeing all these policy frameworks being used to kind of control FX weakness, but we aren't seeing the rate hikes yet, outside ASEAN, that you need to really control this. So we come into the Bank of Japan, we come into the Bank of Korea now with the anticipation that rate hikes are required to get the FX situation under control. We will see whether they are willing to hurt retail sentiment in the equity market by doing that. So those two issues are quite intertwined at the moment.
Anthony, we talk about how the Kospi is tumbling as much as 8% from the get-go. Yet, when you take a look at the currency right now, it is actually trading in the positive. Square that for us.
Well, on the FX side, the government calling up a FX desk is quite frankly, a pause, right? If you are sitting on a FX trading desk and you get a call directly from the Korean government, you will take a break for the day, right? And that is kind of what they intended. And that is very similar to the Indian regulator, a couple of weeks or months ago. So the Asian governments are basically telling FX traders, don't make one-way bets. We're going to check you once or twice. Then we're going to do policy incentives around bond trading and so on, and then maybe we do rate hikes. So they're trying to slow this wheel. Now, in terms of equities and FX correlation, Korea is also a very weird place because the Korean market has been doing so well that foreigners have been taking money off the table, and that has been weakening the Korean won. Today, you saw foreigners are wavering between net buy, net sell because the market has suddenly become so much cheaper. So they might actually end up being flat on FX on the day, which is a big change in dynamic from before.
Yep. Anthony Stevens, Bloomberg Markets reporter. We thank you so much for that. Let's get more insights. Martin Horne is Global Head of Public Assets and Head of Europe at Barings. He's usually based in London, but today he's here with me in Singapore. Good to have you with us, Martin. We had Anthony say, don't make one-way bets in FX. Don't make one-way bets even in equities. It's not surprising we're seeing the sell-off after 9 weeks of gains.
Yeah, I think if we take a big step back, the financial markets are increasingly about speculative money getting thrown at different themes. We saw it with meme stocks, we saw it with Bitcoin, we saw it with gold, we saw it with Mag 7 investments, and not much of these momentum trades, if you like, are based on fundamentals that you can actually ascribe specific valuation points to. If you think about where we are with AI right now, it's all about us betting on a future state of earnings, a future landscape of the industrial footprint, and whenever you're in future state investments, you're going to see these gyrations. I was on your sister program on Tuesday and everything was positive. We were talking about the best earnings season in 15 years, great chip numbers coming out, and the IPO stories that are coming down the track. So really, really positive. 4 business days later, here we are. And I think we've just got to get our tin hats on and be prepared for the volatility that comes with the type of investment you're seeing at the moment.
Has anything changed fundamentally? Why are fears, anxiety creeping in only now?
No, I don't think it's changed fundamentally, but I think we've got to recognise that there's a really fragile state of confidence in these markets. And again, that's the nature of these investments, is that you don't know what it looks like. And so it doesn't take much of a headline to tip you back into, this might be overheated, I'm going to just draw back a little bit and see if we can retrench around a different narrative. Now, I don't think anything's changed in the AI story. I'm still very positive about the way that the AI story translates. You and I can see it in our own business models that every industry, every company out there is somewhat speculating around how they can use AI and how they can change the way they manufacture things, the way they offer services. So we're all doing it, and we can see that. That's slightly different than the dot-com bubble, which people like to make comparisons with. So we are all in on AI. There is no way to hedge this. We are in on the story, and we're going to have to ride this roller coaster because we are going to get that oscillation, I think.
So, Martin, buy, because every sell-off so far has been a buying opportunity.
Yes.
Do you buy now?
I'm not good at timing markets, and I'm not good at offering advice on timing markets.
But there are opportunities in this sell-off.
100%. If you're investing and you think on a 3-year horizon, you'll do pretty well out of some of these companies. You also got to be aware that there's going to be some losers out of this, and we're going to flush out the winners and the losers. So you've got to be thoughtful in the way that you approach these markets. But equally, don't ever invest on 1 week, 1 month, 2 months kind of time horizons, because you just don't know which headline is going to upset what might be a strong belief in where the footprint is going.
Is the playbook intact? I mean, I asked that because we heard from Tim Moe of Goldman saying that he is convinced Korea is the place to be. Korea is the biggest opportunities in decades. He talks about how he expects parabolic earnings even, right? I think something like to the tune of 300% upwards from here. Is it still the place to be in? Is Korea the play for AI right now?
It's one of the most concentrated plays, and it's one of the most impregnated with the technology sector. And there's other sectors in the Korean stock market, like defence, that are doing pretty well as well. So yeah, when you look at the Korean profile of the stock market, there's not too many negatives about that. Let's just draw back though. It's up 80% this year in spite of the sell-off and the freeze that we saw this morning. So there's a lot of money in that. It will probably continue to go upwards as we see this AI story translate. But you've just picked probably the most volatile stock market in the world, certainly the most volatile stock market in the last 12 months. So you're going to have thick skin, close your eyes on the right days, and make sure that you're prepared to ride it.
So a 10% decline shouldn't prompt fear. A 10% decline would mean an opportunity for you to get in.
Yeah, I'm a credit guy by my background, so when you say that, you see tension in my neck. but the reality is, with this wave of momentum, yeah, I think that's right. These are speculatory bets that are being placed on. That's the market that has the most speculation around it, and it probably does play upwards. But my words, are you in for some interesting days?
And credit, debt, I mean, the AI theme is also huge there. You know, people talk about that 60-40 portfolio. It's still about the AI trade.
Yeah, AI is impregnating everything, right? AI is impregnating sovereigns and speculation around inflation. And near term, I think we can take it that AI is inflationary, and longer term, it's meant to be de-inflationary. But we're focused on the near term, and there's lots of inflationary impacts in the world that we know about that is causing that curve to move upwards. Also, there's going to be an awful lot of debt issuance by companies. Companies are having to plough hundreds of billions into the AI story, and so they're going to have to tap every capital market that they can, and it's either going to be the bond market or the equity market, and you're going to see this oscillation between pools of capital as they try and invest more into this sort of mountain of opportunity as they see it.
You talk about massive capital. We have to talk about the IPOs coming online. SpaceX, case in point, might that shift dynamics somewhat? I mean, you know, it was a case of, you know, Elon Musk providing dividends, right? I mean, returns. But now he's actually taking money from investors. I mean, might that change the picture?
It could. I mean, we're in untested water with the big three that are coming down the track, right, including the SpaceX IPO. What I look at, though, is think about where Tesla's been trading, which has absolutely nothing to do with being a car company, and absolutely everything to do with the future state of technology and how that's going to reinvigorate various markets. So Musk is now offering his suite of technology opportunities that takes us all the way to the moon. Are people willing to put money behind that? I think you're going to see that they are. And I think there's also going to be a lot of technical pressures for active and passive managers to own that name. And so I think it's going to suck in capital. I think it will do pretty well. It's what it does to the rest of the market and the absorption of capital into the big three. If you're a small IPO coming after that, how do you feel about that? That'll be interesting testing territory.
Just shut your eyes and take a step.
That's
Martin,
exactly
hang tight.
right.
Martin Horne of Barings is staying with us. We'll discuss how markets are grappling with heightened geopolitical risks as Iran and Israel exchange fire. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. Some headlines to tell you about. President Xi Jinping has arrived in North Korea for a state visit, and that's according to Xinhua News Agency. Of course, he's headed there to North Korea in a likely bid to reassert the influence of China. Remember that Singapore's own foreign minister was in Pyongyang not too long ago. Xi's trip underscores his efforts, by the way, to remind the world and, of course, to remind Kim Jong-un himself, that Beijing remains Pyongyang's most important political patron amid the economic ties. And we have another headline crossing the Bloomberg. The Iran did come out to say that it did not launch any attack at Saudi Prince Sultan base, and that's according to state TV. And taking a look at where oil prices are right now, they're higher after Israel said it struck what it calls military targets in Iran following a barrage of missiles from the Islamic Republic. Israel's action follows a plea from President Trump to Benjamin Netanyahu not to retaliate. Brent crude currently up by almost 4%. New York crude also up by as much. Let's get to Bloomberg Managing Editor Jill Deeses for more. Jill, put this latest headline in perspective for us.
Well, right now, Haslinda, at this point, we're still waiting for more details on the scope of these retaliatory strikes by Israel. What Axios news outlet is reporting is that a U.S. official is saying that they were limited in scope. And I think this is really kind of key here, Haas, because at this point, what we're dealing with is a very, very fragile ceasefire arrangement between the U.S. and Iran. Any kind of outcome over peace talk negotiations, anything kind of longer lasting is likely very, very contingent on what happens with Israel's involvement in the Middle East, whether or not there's any kind of a ceasefire that can ultimately be reached there. And the fact that you have Iran and Israel trading strikes over the weekend into Monday does seem like it marks a pretty serious escalation here. Certainly, it raises a lot of questions about the fragility of the ceasefire agreement, and some of the most violence that we've seen has been happening over the past couple of days and over the past week since that U.S.-Iran ceasefire was announced back at the beginning of April. So the fact that we've got these types of strikes, I think, really does raise some serious questions there about whether how Donald Trump in particular is going to perceive this, given some of his really strong warnings to Netanyahu overnight.
You got to wonder, Jill, whether Netanyahu will ever listen to Donald Trump. I mean, we're seeing this tit-for-tat strikes amid Donald Trump saying, you know what, do not escalate.
Yes, that's right, Haas. I mean, look, you can sense a bit of frustration there coming from Trump, this idea that he's saying, look, I'm the one that calls the shots here. And there's been, quite a bit of back and forth with Trump trying to speak to Netanyahu, particularly over the last couple of weeks, given how much Iran has really made that idea of a ceasefire between Israel and Lebanon a maiden contingency of these ongoing peace talk negotiations with the United States. I mean, we saw at the end of last week, the U.S. announced, alongside Israel and Lebanon, the idea of a ceasefire. Hezbollah didn't agree to that. Now we're in this situation here. We'll have to see whether things continue to escalate.
Jill Deeses in Hong Kong, thank you so much for that. Let's get more on how markets are reacting to geopolitical risks with Martin Horne, Barings Global Head of Public Assets and Head of Europe. Does it matter? I mean, we've seen the markets look past the Iran war. Is it back worrying about it?
It will be on a regular basis, on a periodic basis, as the headlines grow around this issue. Because the stuff here we know, the last conversation was about a lot of speculation. We know that June 30th is quite a big date for restocking of energy supplies around the planet. We know that European gas supplies, for example, are about 15% below where they should be for this time of the year. We know it would take at least 30 days to open up the Strait of Hormuz, and that assumes that there's an agreement today. And I think we can both agree there's not going to be an agreement today with those sorts of headlines. So there is going to be an impact in the winter. We've gone past the point where you can just sort of shrug this off. The latitude of whether that's really, really severe or something that's more manageable relies on a whole series of factors that we don't know. We know, for example, we don't really know where China's energy reserves position is, and that's a really, really big factor. We don't know how there's going to be a resolution and over what time frame there's going to be a resolution. And as we grow into winter, we're going to start looking at things like the weather forecast. It's an El Nino year. That usually brings a milder winter to landscapes like Europe. And is that going to be a factor that keeps this in a box that's manageable? But the headlines around inflation, the headlines around how central banks will react, they're going to grow, and we're on the clock, and it doesn't look like we're finding anything that's going to make this go away too quickly.
It does feel like the market's underpricing that oil prices can actually surge from here. The reason why prices have remained pretty contained is because of the buffers. Those buffers are getting depleted, and it's going to take a long time. You talked about how it may take a month, but when it comes to oil infrastructure, it could take 6 years.
That's right. And I think the markets have got used to the way that the global economy can adapt to pretty extreme situations like COVID, extreme situations like when Russia invaded Ukraine, and jurisdictions like Germany were so dependent on Russian oil. How did they get through that winter? There is an adjustment factor that we should not ignore that may put a cap on how severe this is all going to be. However, we've been distracted. We've been distracted by AI. We've been distracted by other headlines that have meant the financial markets are willing to ignore this. Almost they're assuming that central banks will treat this as truly transitory. You know, that phrase that they won't use again, we know that. But this is an event-driven series of inflationary pressures. If the event goes away, the markets are so used to the snapback. You know, we're so used to the volatility, and they want to believe that the event will go away. But we've yet to see how quickly that will happen.
You talk about central bank moves, the Fed. I mean, 50% chance of a 50 basis point hike by the end of the year.
Yeah.
We could see more.
You could. I suspect that we won't, but it's only an opinion, and it's an opinion based on, you'd have to tell me how the Fed being more aggressive with upward movements of rates will affect the oil price in this situation. You'd have to tell me how the Fed being more aggressive with rates would affect AI spend. You'd have to tell me how the Fed being more aggressive with rates would affect things like tariff impacts on inflation. If you want demand destruction, you've got that in front of your eyes. We're seeing it today. So I don't think central banks will be anemic. I think we will see some reaction. The longer this goes on, it somewhat becomes inevitable. Do I think it will be over-aggressive? Really depends if we're still talking about Iran in the winter time.
Martin, I would just jump in here. The jobs numbers were strong, resilient. I mean, never mind AI, decimating jobs, never mind the inflationary environment. I mean, is that sustainable?
It seems to be at the moment, and there's this whole series of factors. Why was the US jobs market so strong? Is it immigration control? Is it the right areas of the US consumer belt have been earning pretty good money from all sorts of market movements? And you take a 5-year perspective on where the markets have gone to, there's a lot of wealth there that is getting redeployed into that economy, which is creating that job growth, is creating that resilience that we've seen in the US economy. How do the wheels come off? If this is sustained and if we get an erosion of confidence, you can see that people will pull back. And already in certain sectors like the financial service market, you are seeing job contraction.
Right.
And that's about AI as well.
Martin, great having you on the show. Martin Horne, Global Head of Public Assets and Head of Europe at Barings. Still ahead on Insight. South Korea's Kospi paring losses, but still in the red as investors dump tech stocks, while Indonesian assets extend declines amid mounting concerns about government policies. Keep it here with us. This is Bloomberg.
To be a technical correction, albeit a scary one, in a longer-term bull market. And I think we laid that logic out pretty clearly in a report we did last week, where the underlying fundamentals are still very, very strong.
Welcome back. You're watching Insight. That was Goldman Sachs Chief APAC Equity Strategist Tim Mo speaking to Bloomberg as Korean stocks tumble. Now, Goldman had earlier boosted their outlook for South Korean equities. South Korea's Kospi has plunged as much as 8% and triggered a circuit breaker early in today's session as the sell-off in technology stocks gathered pace during Asian trading. It is a significant reversal for South Korean stocks, which had been outperforming global peers over the past year. For more, we're joined by the managing editor for Asia Equities, Lian Tu. I mean, if you talk about a surge of 100% year to date, what's 8% decline?
Yeah, exactly. Some people, as Tim actually mentioned, it's a healthy correction. But there was a lot of panic over this weekend just about how the market was going to open. Given the 5% drop in the Nasdaq 100 on Friday, we saw a bunch of social media meme, being circulated by retail investors. One that went viral was about a bunch of dishes about to come out of the kitchen cabinet and crash onto the floor once the market opens. And we did see about, as you said, 8% opening down and circuit breaker got triggered, but right now we probably saw losses got paired by half of that. Overall, some people are saying, the market has become too risky to invest in, and some people, including Tim, was saying, fundamental is really strong with corporate earnings still growing. Net to me, one thing that really stood out to me was just how this crowded and concentrated positions have made the Korean stock market extremely volatile and to certain degrees unhealthy, right? We've got two stocks pretty much driving all the gains. We've got retail investors using so much leverage, still trying to boost their returns.
So the current story is still intact, but as you said, Lian Ting, it is leveraged bets that's really causing the nerves in the markets. We could still see unraveling of the Korean market. The risk is still there.
Totally there. We are seeing two sorts of, sources of leverage. One is margin debt onshore in Korea, margin loans taken out by retail investors to bet on stocks is at record high right now. We are also seeing leveraged ETFs, those listed in Hong Kong and now recently listed in Korea. Also could mean the rebalancing flows could actually exacerbate the losses, also amplify the gains. So with all these things coming together, I think, again, the stock market will continue to be the most volatile in the world.
Also, what's in focus today is the Korean won. I can't decide if it's resilience or not. I mean, this is a currency that's been under so much pressure, but today, despite the sell-off, it's still finding its footing.
Yeah, it was down about 2% on Friday. I think today we see a little bit of rebound. Overall, it is quite an interesting story with the stock market being so strong. The currency is at the lowest since 2009. I think different stories, different drivers. For the one, overall, it's driven by flows, driven by external balances, also growth rate. And if you look at flows, the Korean stock market is seeing record outflows, and there is also concerns about the trade negotiations with the U.S., believe it or not. And of course, Korea is extremely reliant on energy imports. So all three things would mean that the won is actually quite under pressure. And usually a weak won is good for Korean stocks because a bunch of their companies are exporters. But if the won is extremely weak, then
at some point,
exactly, it reduces the appeal of the Korean stocks.
It begs the question how the Bank of Korea views the currency's weakness.
Yeah, I think there's a lot of concerns about whether they are actually behind the curve, right? And that also means there's expectation that they have a lot of catch up to do. So the next sort of policy decision is very much going to be, whether it's a hike and how big the hike will be.
Yeah. Playing catch up at some point. Lian Ting, thank you. Managing editor for Asian Equities, Lian Ting Tu there for us. Now to Indonesia. Indonesian assets are also lower, extending last week's rout as mounting concerns over government policies weigh on investor sentiment. Let's bring in Bloomberg Markets reporter Anthony Stevens. And of course, we've seen the JCI continue to slump lower and lower. They are the worst performers in the world, Anthony.
Yeah, the market is kind of grappling with the pace of economic change and policy change in Indonesia. When you're an emerging market, uncertainty is a killer, right? And now there's uncertainty around economic policy, there's uncertainty about the equity market, and there's uncertainty about the FX market. So on economic policy, ever since Prabowo took in power, he's basically tried to get more of the benefits of Indonesia's commodity exports into the country. Now, on the face of it, that's a noble goal, but the execution of it has turned out to be a problem. So he has export controls starting this month. The execution of that is very uncertain. Coal prices are already increasing due to delayed shipments, and that's obviously impacting exports. Now, on the equity side of things, the MSCI and other index providers are finding fault with Indonesia for its family-owned structure at the top of the market. There's just not enough free float to kind of justify Indonesia's weight in emerging market index. So that sword hangs over the market, and it hasn't been resolved yet. So the market is looking forward to MSCI's review later in the month to see how this gets cleared. On the FX side of things, the country continues to work down its FX reserves. The reserves are the lowest since 2018 as they battle this outflow from both the equity market and the higher rates that are coming in, from the US. So there's a confluence of factors here that are unfavorable. Now, for Indonesia to turn the corner, what is required is clearer communication from the government on the rate of policy change and what is the final systems going to look like around the equity market, around the export controls, and around some of the government programs and corruption crackdowns that are in the work as well.
Of course, not to mention murmurings right now that we're hearing that could be a change in the finance ministry position. Anthony, I'm just wondering if there is anything out there, if there is one policy that could reverse the situation for Indonesia. This is a crisis of confidence.
That is 100% correct. Emerging market investors have very long memories of how messy government change in the middle of economic change can be. Cast your mind back to the China corruption crackdown or the Vietnam corruption crackdown as they were transitioning their economies. That's extremely disruptive. Investors don't know who to go to in the right seat. So that is the first thing that needs to be fixed. And Danantara today is on the tapes talking about a simplification of the process. So that's a good sign. But in terms of the actual terms of what is required for foreign investors to continue to doing business in Indonesia, that needs some clarity. And the Bank of Indonesia also meets June 18th, and some clarity on monetary policy going forward and acknowledgement of the rupiah struggles is also going to be very important to markets.
And Anthony, when it comes to Prabowo's report card, it's not looking pretty, is it? I mean, the currency is down something like 13% since Prabowo came to office. Talk to us about how he has done, how the markets have done under his administration.
Look, it's also a little bit of timing, right? Like when he instituted a lot of these policies, Indonesia was doing really well. The market's down around 39% from the highs and now is about 16% lower than when he started. But that's a huge range. And part of that is because Indonesia initially had a lot of space and a lot of grace given by markets given its growth rate. But after the Iran war, that space has absolutely evaporated. The country is an energy importer. The country does not have any AI. So it's on the wrong foot against some of the biggest investment themes of markets right now. And as we touched on, across the show, the whole of today, emerging market FX has no place to hide if you don't have any AI and you don't have any incoming foreign investment. So Indonesia decided to pick a very wrong time to play with its exports, frankly speaking, given that that's what would have supported the rupiah. And also his social programs, which politically play very well, are very expensive. So his free meal program is in the region of $20 billion plus. Now, when Indonesian exports were booming and foreign investment was flying into the country, that is very easy to carry as a bill. At the current situation, not so much, given how badly the FX reserves have to be drawn down to support the currency.
Great insight, Anthony. Bloomberg Markets reporter Anthony Stevens there for us. Now, still to come on Inside, India's central bank and government firing a policy bazooka to support the rupee. Nomura's Sonal Varma shares her take on the latest steps to revive foreign inflows. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. We're keeping an eye on the Indian markets coming on board in about 4 minutes from here. Just ahead of the open, traders will get their first chance to react to Friday's GDP data, which showed that India's economy grew faster than expected in the first quarter. Now, India's government and central bank also taking coordinated steps to attract foreign inflows. Investors say the double-barreled intervention could see as much as $50 billion injected into Indian bonds and stocks this year and reverse an outflow that's dragged the rupee to a record low. Now, for more on India's measures to attract foreign investors and the latest growth numbers, let's go to New Delhi and our South Asia economy editor, Ruchi Bhatia. Ruchi, how much will the RBI and government measures really help?
It does look like, Haslinda, these measures will help a lot, because this is for the first time after the pandemic that we've seen a coordinated action, all hands on deck approach, so to say. And in fact, many people are even calling it a bazooka of sorts that will not just prop up the rupee, but also get the much needed inflows into the country. There are estimates that the measures that the government and the RBI announced, which includes, of course, the tax cuts for investors who are investing in government securities, relaxed FPI limits, expanded bond access, that together will get about $50 billion worth of inflows into the country, and that could perhaps be enough to even stem the BOP gap or the deficit that we were seeing for this year. Having said that, on Friday we did see the rupee gaining to the most in almost 2 months. We're of course keeping a close eye on the rupee moves going ahead as well. Having said that, however, remember there are going to be longer term problems as well that the Indian government will have to address. We are in a sort of a geopolitical crisis that is putting the pressure on India's fisc as well. Growth, however, while we're seeing a good number for the fourth quarter of last fiscal year, growth going forward will continue to be kind of weak. The RBI may perhaps look at interest rate hikes going forward. Inflation is on the rise, and on top of all of it, we're seeing the U.S. trade deal still not being signed. So there are some risks on the horizon that the Indian government and the RBI will together, will have to kind of tackle.
Talk to us more about that growth you're referring to. India's economy grew faster than expected in the 3 months through March. I mean, what's the outlook ahead? I mean, if we're considering perhaps an RBI raising rates, that could eat into growth, won't it?
Oh, absolutely. In fact, while, as I said, we did see a good number for the fourth quarter, which was mostly on account of, private investment and a good, showing as far as gross fixed capital formation is concerned, which is a proxy for investment. If you see, there was some sort of a tempering in consumption, and which is why I say that going forward, there are risks on the horizon. There is a geopolitical crisis that's playing out that will put the pressure on India's fiscal position. There is also a forecast for a subpar monsoon, and remember that really has the potential to hurt India big time. Having said that, inflation is going to perhaps inch up. The RBI spoke about it as well. In fact, the RBI on Friday raised their inflation forecast and said that growth could be on the lower side. They've lowered their growth forecast. So all these are pointing towards a more gloomy sort of outlook. How the Indian government and the RBI manage it is something that we will have to wait and watch out for. Economists are also pegging as much as 50 basis points worth of rate hikes going ahead. So that is something that is an important factor to keep in mind.
Ruchi, thank you. South Asia Economy Editor Ruchi Bhatia there for us. Let's get more with our next guest. Sonal Varma is Nomura's Chief Economist for India and Asia Ex Japan. Sonal, good to have you with us. We talk about the coordinated measures taken by the government and the RBI. Is that enough? Will those measures be enough?
They do look like they will make a substantial dent to the balance of payment deficit we were tracking for this year. So if we take a step back prior to most of these announcements, our estimate was India's balance of payment would record a deficit of close to $70 billion US. The measures announced by the government and the RBI, even prior to that, the government had announced measures to actually restrain gold and silver imports, which will narrow the current account deficit. And the capital inflow measures that have been announced on Friday, we do think cumulatively can get more than $50 billion US dollars. So a substantial part of the BOP deficit that we were tracking prior to the combination of announcements does look like will get plugged. And importantly, a lot of these inflows, particularly on the diaspora bond, the FCNRB scheme, the dollar raising by public sector companies, a lot of these inflows need to be brought back into India by 30th of September. So there will be front-loaded inflow into India's capital account.
When you say that it is enough, but is it enough for us to get the situation back to equilibrium?
For the near term, and I think for at least 2026, yes, it does look like we should get to equilibrium. So I think the two big announcements from last week, one is the FCNRB deposit scheme. India has actually announced 3 to 4 such schemes in the past history. Back in 2013, the FCNRB scheme had raised around 1.4% of GDP. And the two prior schemes before that, which is 1998 and in 2000, India had also raised around 1 to 1.2% of GDP that far back. Now, you could argue that interest rates today in the US are much higher. Banks may not give as much leverage as they gave back in 2013. But even if we get a 1% of GDP, that's still a substantial $40 billion in inflow. The second big one is the ECB limit for the public sector companies, where the RBI will give some concessional hedging. Our rough estimate is this can get around $10 to $15 billion in inflow. Banks are already constrained domestically because of high credit deposit ratio. So this should also help banks actually partly plug this credit deposit gap. So it actually does address two problems. It brings you more dollar inflows, and it leads to also addressing some of the credit deposit gap. So yeah, it does look like it is substantial. Of course, we need to monitor how things play out globally in terms of both the oil price outlook and the Fed rate outlook.
Right. And Sonal, even as we talk about equilibrium, is there a sense that India actually can live with a slight imbalance? If you talk about, that equilibrium coming in 2026, could we see a slight imbalance? And is it okay if that happens in 27?
Well, if you're talking about imbalance on the balance of payment more broadly speaking, then, the thing is this year is going to be the third year of a balance of payment deficit for India. Over the last 2 years, even as India was running a current account deficit of less than 1% of GDP, we still face challenges on the BOP, and that has been because of the lower capital inflows. This year, of course, it's been a combined impact of wider current account deficit and lower net capital inflows. And I think what we've observed in the last few months is a bit of, depreciation feeding into more depreciation. And so it was becoming a vicious negative spiral. So I think what these measures do is essentially try to put a gap, a cap on the depreciation and bring about equilibrium. From a more medium-term perspective in 2027 and beyond, I think more measures will be needed. Things on how do we become more self-sufficient on energy, for instance, how to reduce the amount of FDI repatriation India has been seeing or slow the pace of FDI outflow. How do we revive foreign portfolio investment flows? How can India integrate into the AI story, if not through AI production, then at least through the AI adoption side?
You talked about how it is all contingent on the price of oil. The Iran war is now into the 4th month. Oil prices today continue to surge. I'm just wondering how that feeds into your calculation, given that India continues to be a major oil importer.
I think for this year, for this financial year, which is FY27, we are working with the assumption that Brent crude oil price averages around $95 to $100 per barrel. So even with the latest escalation, we are roundabout at that number, and with that number, we think the current account deficit will be around 2.4% of GDP. So this is manageable this year, given the announcements we've seen from the RBI and the government. I think the current level of oil price is manageable. Of course, the question is whether this is sort of the new normal, in which case, there will be challenges on the BOP side in the next calendar year. But at current stage, I think India has managed, the physical supply of energy relatively well. It's been more of an energy price shock. It has been a fiscal shock for the government. We do think the fiscal deficit is going to worsen. And the bigger impact, of course, is going to be on companies because their profit margins are now under pressure.
Sonal, some people are suggesting that the stability that can be expected in the currency due to the slew of measures is just a band-aid. It's not sustainable going forward because it is a structural issue, the issue being India's inability to secure long-term FDI. What's your take on that?
So, first of all, I think it's a sizable impact of the cumulative impact of these announcements. And if it is actually plugging, a major part of the balance of payment deficit for FY27, then I think one needs to acknowledge that this is a big bazooka. Now, in terms of, how does India, manage the FDI outflow? So if you break down the FDI, we have seen continued increase in gross FDI inflow. In fact, gross inflows will be close to over $90 billion currently over the last 12 months. The challenge has been more the repatriation of FDI, a lot of which was actually money brought in during the pandemic year. Investors are essentially, taking profit based on high valuation. And the second has been the FDI outward direct investment we've seen from some companies. Now, I think in a sense, if companies are taking profit on their money that they invested in India, that's part of the deal, and India will need to deal with it. But on the outward direct investment, the outflows we've seen, which is like close to $30 billion US dollar, is on the higher side. And one needs to look into what exactly is driving this. So I think overall, focusing on the ease of doing business, continue to do, reforms, focus on the supply chains that are moving from China. I think the whole policy package will be important going forward.
Sonal, what would it take for the RBI to raise rates? It does seem like the bar has been set really high for the RBI to do that. That is one way to actually put some stability in the currency.
Not necessarily. I think India's structure is very different. A lot of the capital flows that India attracts are actually growth capital. And the 2013 interest rate hike to defend the currency actually backfired. So I don't think interest rate hikes will actually help stabilize the currency, which is the common notion. It has not played out in India. The measures that have been announced, which is the non-monetary measures, are actually the more effective way to manage this. And the trigger for the RBI to hike interest rates is essentially a generalization of price pressure. So headline inflation is expected to rise, but it will take a material pickup in core inflation for the RBI to respond.
Sonal, thank you. Sonal Varma, Chief Economist, India and Asia ex-Japan at Nomura. Now, before we go, here's a look at tomorrow's show. We'll be speaking exclusively with Bombardier's Executive VP of Aircraft Sales and Aftermarket Services, Paul Sicilian. Keep it here with us. This is Bloomberg.